Welcome in. It's Friday. You know what happened last week? I wore my Penn State jersey, and they went and played Auburn at Auburn, and they beat them 41-12. So from this point forward, I'm going to be wearing the jersey with the color of either home or away for Penn State, because obviously that's the reason they won. Come on in, everybody. Welcome. Community Forum, Friday, September 23rd, 11:03 a.m. Very special guest today. He's been on the channel multiple times, but he's going to join us in a community forum style as every other Friday that we do here. So come on in, everybody. Make yourselves at home. Make sure you can hear me okay in the comment section. Let us know where you're from. Drop your location. And let's welcome in our community forum guests. We have Borghand, a.k.a. Richard. We got Hans. We got Kuba. And our very special guest, the one and only, Emmet Peppers. How you doing, my friend? Good to see you.
Doing well, thanks. Good to see you too.
Yeah, man. Cool. Yeah, Emmet's been a guest of the channel multiple times. It's always a joy to have him on, and we've also had Matt and Emmet both run a fund together called Good Soil Investing Management. Sorry, I want to make sure I get
it's Good Soil Investment Management. That's the name of the management company. The fund is actually called Accelerated Opportunities Fund LP. So, Perfect. It's not a traditional hedge fund where you're like long short. We're mostly long. And, it's trying to accelerate the opportunities we see. And it's been a tough year, obviously.
Yeah. So one of the topics that we'll kick off with here, and obviously on everyone's mind ever since we had the Fed meeting on Wednesday, the Fed came out and did another 75 basis point rate hike on the interest rate. I guess let's put the simplest way to put it. What's your take, Emmet? We'll start there and kind of hear your thoughts, and then we'll allow this sort of conversation to flow from there. So, where's your head at with this latest move from the Fed?
Yeah, I listened to Powell speak after the decision and the statement, and I feel like Powell is mostly a straight shooter by nature. My read on him is he just wants to tell it like it is, but he wants to be very professional, and I feel like it's hard. It makes it almost. He doesn't want to let people read between lines, but I feel like if you can read between lines, then maybe it's easier with Powell because he's really just straight shooter, but he sticks to the script for the most part. So there's like Q&A and stuff, and you can just listening to him speak. I feel like there's been I guess it started with Jackson Hole, but now it just seems more clear that they're just so focused on crushing inflation or inflation expectations that they raise their estimated unemployment rate acceptance or tolerance even, and they're like preparing themselves to just like batten down the hatches and keep raising rates until they see really significant changes to inflation on data points that are very arguably obsolete in some ways, with the equity owner's rent making up 40% of the CPI, and that's delayed like 12 to 18 months versus what was really going. So there's interesting things about it, but I am worried that they are really determined to raise rates to 4 to 5%, and we may look back, in a couple of years and be like, and it might be like widely accepted as like, the last 5 or 10 years being like the great interest rate bubble of like no interest rates for 5 or 10 years. And it's like widely accepted in a couple of years from now that like you have to have interest rates of like 4% or 5%. Otherwise crazy things happen, like cryptocurrency, SPAC mania, all these crazy things, startups like all over the place. Everyone and their cousin is setting up a startup because money is practically free with zero interest rates. And so I feel like there could be a narrative being the stage set for right now, where we're kind of entering an interest rate environment that's going to be very long term, 4% plus, and it's not a temporary. Previously I was thinking maybe it's just temporary until they see the CPI and the producer price index start coming down. They'll stop raising rates and get ready to pivot to come back down a little bit. But now I'm feeling more convinced that it's just going to be longer term, 4 to 5, maybe even 6% interest rates. And, the people, the old guard, the older folks that are like that remember interest rates being 10% plus and so forth. They're like, all right, now we're getting back to normalcy, and they're like the decision makers here, and they're just going to keep it that way. And I'm sorry, that narrative, I'm not certain of it, but I feel like I'm like 50-50 on that playing out like that. It just seems like a very realistic scenario, and we'll never know what the other narrative could be if they reduced rates back, if they brought it back down to 2% in the next couple of years, or 1% or whatever. We'll never know how much faster the economy could have accelerated or grown if they didn't, raise rates perpetually from here. So that's kind of what I'm playing with and juggling in my head, those two different possibilities. They both seem almost equally, probable in my mind. I don't know. What do you guys think? Or
The thought that comes to mind, and I'll please the panel feel free to sort of give your 2 cents here, but so this is the first time, and I'll speak from like somebody who's not an expert in finance, who's not an expert in this kind of stuff, but I've taken a lot of intrigue in it because, over my investing journey, I find that these things very much influence the holdings that I have. So if my liquid net worth is predominantly in Tesla, then what the Fed says, I've learned, really impacts what happens here, right? So it's a really interesting learning journey for me. What sticks out in my head is that the last time they raised 75 basis points, the language that was given by Powell was much more like, hey, we're nearing the wait and see. We're nearing the wait and see approach. And, we might, we're going to take it quarter by quarter. And, there could be a pathway for us to potentially see inflation coming down to a point where we're going to have to take a different approach to how we're raising rates. And then literally a few weeks later with Jackson Hole, it was a complete 180 in a very short time frame. So in my head, I'm like, what has happened in that time frame for such different language to arrive, and how come such few people have so much impact on everything? So that's been my learning sort of discovery right now, and I'm really trying to grapple with the fact that there are these sort of variables at play in the economy and for people that hold stock or whatever, where very few people could very much make decisions that could inflict some pain on those that are holding those shares. But I'm just uncertain on where we're going with the Fed. And the reason why I even say that is because if they're able to make such a quick about face about their language, about, hey, we might want to take it this quarter to quarter approach, and then all of a sudden it's like, no, we got to squash this thing super, super hard. I'm like, okay, what happened? What happened? Can you be straight with me for a second? I might be overreacting, but that's what comes to mind to me. I don't know if anybody has any thoughts.
Well, one thing I'll say real quick is that point you bring up about what has changed between the last 75 basis points, they're going to wait and see, versus the Jackson Hole meeting. Things clearly changed the tone, and now we're this much more hawkish place with Powell. And one reason why I'm only 50%, I'm on the fence 50-50 is because I think inflation expectations is maybe the elephant in the room that Powell is really fighting. Inflation itself is one thing, but inflation expectations is sort of, I think, a main driver of actual inflation. Do businesses or individuals, if you're running a business, are you setting your contracts in the future expecting inflation to keep rising? And if so, it's a self-fulfilling prophecy. Then inflation does keep rising. And so if the Fed is not hawkish enough right now, then it allows for businesses or whatnot to continue thinking that inflation could continue. But if the Fed and the other, is really hardcore right now and hawkish and makes a big dent in the market and the economy, then businesses are like, oh, the Fed's got inflation, we're going to set our prices in the future because we don't think inflation, so inflation expectations to a large degree drives inflation. So maybe the argument is he's trying to be extra hawkish right now just to get inflation expectations under control. And then when everything's kind of clearly under control in 6 months or whatever time frame, they can pivot to be a little more dovish again. That's the hope. That's the optimistic me kind of thinking that plays out that way.
So it's more like trying to it's like a human psychology game almost, right? It's like that. So that's crazy. to me.
Yeah.
That feels
Yeah.
insane.
Because if everyone
You know?
expects him to like take rates back down in the beginning of January, in the beginning of 2023, then I think a lot of the businesses that are planning their pricing or supplier agreements and whatnot, they kind of account for that. And they're like, well, interest rates are not going to be up very long. And, inflation is not really subsiding. We're going to price it here. So there is a lot of psychology. I think you're right in the decision potentially.
It's so fascinating. Any thoughts from the panel? Like, so many things are coming to my head, but I want to make sure I give space to everybody else. Hans, Richard, go ahead.
Okay. Yeah. So I was thinking, I'm kind of the Jerome Powell here, close in age. And I remember in 1991, I bought my first house. I got an adjustable mortgage. So it was a discounted teaser rate. It was 7.99 was the entry, the cheap discount rate. The prime was well over 10. But you only have to go back 10 years. Before that, that's Jimmy Carter. So that means prime is close to 20. But it took 10 years for it to drop half, in essence. That's a long time. I don't think we're going to ever get rates like that, but you have to keep that in mind. And Emmet, I agree with Emmet in terms of the part. It definitely is part of my psyche. So I do remember those times. And when interest rates were at 1-2%, it did seem incredibly cheap to me. So I think if you're over a certain age, it is kind of baked in, just by nature. The factor I think that troubles me the most is housing, because it's to me that is a real difficult issue. One, because as interest rates go up, construction is going to go down, and there's already there's a shortage of housing anyway. But as construction ceases because it becomes less profitable and because people can't borrow money, that gap is going to widen, and the demand on rental housing is only going to increase, which is going to force rental costs up, and that's part of core inflation. And whatever the imaginary rules that the Fed operates under, they seem to distinguish between core and non-core inflation, and purportedly they focus on the core part, but housing is a substantial portion of that core part. And if that continues to rise, that's going to be a really difficult feat. And finally, the other part is, from where, and I don't know how this plays in, but from where they started this journey on trying to battle inflation, the world economy is in the shitter. It's substantially worse, which I think makes the job even more difficult and more complex, but kind of puts a greater pressure on not raising interest rates. Because if you're going to go into a worldwide recession, then you don't want to suppress economic activity. And by continuing to raise interest rates, you kind of are going to do that. So it's I just think it's a really complex and difficult issue.
Yeah, and then the other factor to remember is also that the government has a lot of debt that they have to service. And so I don't know how much pressure the Fed is under to keep interest capped below a certain rate just to keep the government's interest payments reasonable. So yeah, that was one of the questions also that came up in the chat. But that is one of the things that I also wonder about being in the psychology of the market, is that maybe there is kind of an implicit assumption by a lot of market participants that, hey, this can only go so far, that we can never go even to 10% again, because it would crash the government's ability to even operate.
Yeah, I think what's also interesting for me is the fact that, the Fed was in a, they gave specific language not too long ago, that, it was the whole transitory thing, like the inflation was going to be transitory. And then, so for like a period of time, they didn't really do anything. Oh, we lost Kuba. I'm sure he'll be back. For a period of time, there wasn't any indication that the Fed was going to step in and raise rates like crazy. And then they started raising rates like crazy. So in my head, it's like, okay, so we were in an environment where the Fed made a decision that they didn't think they would have to make. And it came it came almost as a surprise to them. I wonder if the same dynamic is going to happen when they are almost forced to stop raising rates if that inflation number that people have been talking about, like your Kathy Woods, your Elon Musks. Like, I wonder if Jerome Powell follows these CEOs' Twitter accounts or whatever. That it's giving them signals that says, hey, like the supply chain is starting to ease up. Like we're seeing. If Elon comes out and says, hey, if the Fed should reduce rates by 0.25%, he's seeing something in the supply chain that's telling him that, hey, inflation has come down tremendously. Like we need to resolve this. So I wonder if there's going to be that same dynamic that happened with the transitory language that he was giving, where before we know it, Fed's going to be like, okay, you know what, we're going to stop raising rates because something has changed, and all this noise that's been bubbling up in the supply chain now about how prices are come back to normal is going to influence their decision. But who knows? It's just the guessing game is what's kind of like a fascinating thing for me to learn, because these decisions make such an impact to the economy, yet nobody knows what the hell is going to happen here in the next 3 to 6 months,
Yeah, and I mean, none of us wanted to be. I mean, I don't know about you guys, but I didn't want to be I'm not an expert by any means, but I didn't want to like follow macro markets of the Fed every remark. And but when we're so invested in Tesla, and you see Tesla and the entire market going up and down 5 or 10% a week because of a surprise speech at Jackson Hole or a CPI number anticipation, it just you really need to follow that stuff, because stocks are not moving independent of each other. They're all kind of moving up and down together. Like the breadth of the market is just really inhaling and exhaling very widely recently, because of the Fed and this macro market stuff. And so you have to really follow this stuff in these times. I can't wait till we get back to like some stability where, this stuff, interest rates are stable. Everyone knows they're stable. Inflation's under control, and we can just kind of like focus on stocks earnings. And that's the dominant factor of your P&L of your brokerage account versus, what words, Powell is using or not using in his speech. Like he started using this word restrictive level a lot recently in this speech. And restrictive to what? Like, I guess they're at this low end of restrictive level. There's restrictive level. They want to restrict, I don't know, like I don't know what they're trying to restrict, to be honest. Inflation, obviously, but it sounds like they're trying to restrict like easy money or something. They don't want the economy to be too greased up, because it helps inflation, potentially perpetuate if it is. So I'm looking forward to the days where, the Fed is in the background and not in the foreground of our P&L.
Yeah. Okay, cool.
But so maybe this is a fool's game, watching and getting excited about it. I know, Emmet, that you have a different set of circumstances that you actually need to get involved in that. I'm wondering if regular retail Tesla investors really should care that much, because it will pass at some point, right? And then things will be back to normal. And that Tesla itself is doing tremendously well, right? And even better that it's like maybe pushed down a little bit if you're in a phase where you can accumulate. You just build up at lower prices than they would have been, certainly. So maybe we're just putting that stress on ourselves unnecessarily.
I agree, Kuba, 100%. Yeah, I mean, if you're a long-term Tesla stockholder, this is just a lot of noise that you have to deal with, obviously. And in the end, Tesla stock will be worth what it is. The path to get from here to there is, going to be wildly dependent on what the Fed's doing. But if you're holding to there, to where it gets really high, like in 5 or 10 years time, Tesla's going to be magnanimously bigger than what it is now, the business, the profits, and of course the stock, so but in the next 1 or 2 years, it's psychologically painful. So it is sort of like a fool's errand in some, to follow the daily moves of what the Fed's doing and such. I agree, Kuba. So it's good to keep it, if you're a long-term Tesla holder, that's keep your eye on the prize of the business, and it's stronger than ever. And yeah.
Unless you're playing with margin, which I strongly discourage from my own experience.
Yes, margin's very, very stressful for sure. And options, yeah.
I was going to kind of, being an optimistic lawyer, I was going to kind of give you the opposite take on that. And I've thought about this since the pandemic. I was just thinking the relative sequence of events. So there was a war, there was a worldwide pandemic, And then like 10 years later, there was a depression. So I don't know if that was just coincidence or there was some, more of a systematic method for how it ended up like that. But, we presume like this dump in the market and the economy is going to be, typical, maybe a year to 2 years, and then we're out of it and we're back to normal and everything's great. But, this might be an exceptional period in our history because of the sequence of events. And maybe instead of 2 years, it's 5 or 10. And maybe, a long-term horizon is fine, but, maybe it's a longer term horizon and we have to be much more patient than we for today's purposes that we would anticipate. And, I don't know. I don't know. But again, that occurred to me, like when the pandemic started, that first thing that occurred to me was that just happened, or was there some rhyme or reason? The other thing I wanted to address that you kind of mentioned before was about Powell. And I think he makes one misstatement. So his prime directive, which sounds like a Star Trek reference, his prime directive is inflation. So I think he's more likely to crush inflation and go over the top past what he should do just to make sure. So it doesn't surprise me if he mucks it up by going too far. The part that I don't like, and I think he's a little bit disingenuous about, is about employment. And he talks about, he wants employment basically to cool off. But I don't really think that's what he wants. I think what he wants the participation rate to rise. He wants many more people to have to come back into the employment market to keep wages flat so that inflation will be flat. And that's a lot different than just hoping unemployment rises. That means you have to create an environment where people have to go back to work. And he's never said that. And I think if he would have said that, people would not be very welcoming of that kind of strategy.
Can I share something real quick? So along those lines, I found this very fascinating yesterday, where even Elizabeth Warren, so on the side of sort of labor, so she made this comment where the Federal Reserve's Chair Powell just announced another extreme interest rate hike while forecasting higher unemployment. I've been warning that Chair Powell's Fed would throw millions of Americans out of work, and I fear he's already on the path of doing so. So what's really interesting about that tweet, I am no fan of politicians. What's very interesting about this tweet from Elizabeth Warren is that now you have a chorus of voices that are arising from sort of, call it the people that are invested in the markets or are part of businesses that are saying, hey, this sort of high interest rate, sort of what you're doing is really causing us to have a very unstable market that's going to really hurt demand and potentially other things. And then we also have somebody who's representing the people coming out and saying, hey, like this action is going to start killing jobs. It's going to start killing jobs. We're going to run into an issue. So now there's like multiple voices coming at it from a different, like from two different spectrums. And it's sort of, and I wonder if that sort of echoes what Richard sort of was talking about how this is going to, the labor force is going to get impacted by these decisions. But I wanted to throw that out there because I find that as a very interesting sort of dynamic that's arising. Not sure if anybody, and I didn't want to like sort of derail the conversation, but I just found that tweet to be like sort of analogous. As soon as you're talking about what you were saying, Richard, I thought of that tweet that came out, but not sure if anybody has any thoughts.
Yeah, I mean, I think I echo what Richard was saying. And this is something I've been thinking about a lot. Have we just moved into a different phase that we were in pretty amazing period of stability just worldwide, and that created a lot of stability in markets. And then you kind of get these like second and third order effects or like risks kind of building up in the system over time, and over a long period of stability, they just build up more and more. Just kind of like we saw with Tesla stock, except the inverse, where for a long time it just traded sideways, and that momentum and pressure was just building. And then in 2019, 2020, 2021, we saw the stock just shoot up. Well, I think sometimes there are like risks to our global macro environment that do the same thing. And that's kind of what we're seeing with Ukraine and the pandemic. And then we'll see what happens with China and Taiwan. and that there may be a lot more of those shoes that are waiting to drop, and we'll just have to see. But when I think about all that, I do continually come back to just feeling very comfortable with, okay, if I'm going to have asset tied up somewhere that I'm hoping will help me ride out whatever instability comes, I can't think of a better place to put it than Tesla, because there's no one else who moves faster, can solve problems better, and can thrive more in an unstable environment than Tesla can. And so it doesn't matter, I think it's better than gold, it's better than digital gold, it's better than any sort of inflation hedge that you can think of when you own a piece of a company that is growing on an exponential rate consistently with unparalleled execution and agility.
Yeah. I think the one thing that I always go back to with Tesla in this sort of environment is that if we're really going to be in a place where cash is going to become more and more expensive, you should probably want to be in a company that's going to be generating a lot of that and doesn't have any debt, right? I think that's the most fascinating thing about the company. Go ahead, Emmett.
Mm-hmm.
Oh, no, I was just agreeing with you guys both. Yeah, I mean, Tesla is starting to generate tons of cash. It's a different place than it's ever been in. Eventually they'll buy back their own shares with their cash. And so Tesla as, a place to hold wealth, versus gold or cash or anything else, to me seems the most attractive place. Even if the stock price trades somewhat sideways for a while, it's just kind of, I think, the fundamentals of Tesla in the end will win out, of course. And so at some point, I think Tesla will generate cash, tremendous amounts of cash that it won't know what to do with. It's going to be buying back tons of shares, maybe issuing huge dividends. I mean, you look at the maturity of how Apple kind of grew to where it is now. That's sort of a microcosm of what I think Tesla is going to be going through. So Tesla's going to be generating so much more cash than even Apple does now, and have to do so much more with it in terms of like putting it back, giving it back to the investors or buying back shares, because it won't be able to deploy all that cash like in any kind of efficient way. So that's, 5 to 10 years out. And that's worst case in my mind, but in the next 2 to 5 years, if FSD doesn't really take off or the bot doesn't really make meaningful progress the next 2 to 5 years, which I don't expect the bot to necessarily do, then I feel like it's just the manufacturing of the cars. And even though that's going to continue to ramp up and justify the current stock valuation in a declining market, it could just trade sideways for a while before it kind of really ramps up later in the decade in my mind. But, good things come to those who wait, so, I think if you're a long-term Tesla, holder, you study the company well, and it's great that we have this type of like camaraderie these days of these like chats like this. It's almost like a support group for each other in trying times, and all the YouTube channels and spaces about, I think it's all important to tune into all of that and keep the eye on the prize. Like the day-to-day movements is not what it's about. It's about the longer term picture, and if you're using margin or options, then obviously you're focusing more on the day-to-day movements. You're forced to in a way, but that's a dangerous game. And anyone using margin or options obviously should know that going into it.
Yeah. I think about the quote a lot of times. It says that volatility is the price of outperformance. And I can't remember. I think it's a Peter Lynch quote. I could be mistaken on that. But that's one of the things that I think about in these types of times when that, with Tesla's beta, they are going to, on the day-to-day, they're going to have swings that typically are wider swings than if you were in the NASDAQ or the S&P 500. But as far as overall safety, the long term has shown that Tesla's where you should be. So did you have something you wanted to say, Kuba?
Yeah, go for it.
Yeah, I wanted to, because a question came to my head, Emmet, when you said that you likened Tesla to Apple in terms of generating cash and not knowing what to do with it. So Apple has been sometimes criticized for holding on to loads of cash and actually not doing much with it. Do you think, this question to all of you guys, do you think that this is Elon's style, or if they just get a lot of cash, he would be hell-bent on finding some useful stuff for this cash to do, rather than just keep it unaccumulated in the balance sheet? What do you guys think?
You want to go first, Emmett?
Yeah, I was just gonna say, I think Elon's referenced like the term war chest a couple times. When he raised capital, I remember at the end of 2020, I think it was, or whatever, and they raised. It's opportunistic to raise. When the stock was going up, they're just trying to accumulate. So I think in his mind, he must have some like determined amount of cash that he wants to keep on hand on the balance sheet. And it maybe it's proportional to the business to some degree, but I think in his mind, he's got some kind of like formula or a number or in proportion to the business, is for safety reasons.